Thank you for joining this webinar this morning. Much appreciated. I'm Tilman Ehrbeck, Managing Partner at Flourish Ventures. At Flourish, entrepreneurs whose solutions help people capture economic opportunity and improve their financial outlook. As part of my work, I'm trying to stay on top of big picture trends, industry developments that could affect our work. And today's webinar is on these bigger picture trends. We will do two things. We first have a presentation that will take roughly 15 minutes or so. And then we do a Q&A. And so please feel free to type up your questions already as the presentation is going. There's a Q&A button on your console at the bottom. And this way we have a flying start after the end of the presentation. So that's it for the intro. Let's go with the presentation. Some 4 months ago, I was invited to give a keynote at a conference in Mumbai in India on fintech with purpose. And obviously that keynote was canceled over the COVID concerns. So I put the presentation away. But a few weeks ago, I pulled it up again. And what I realized was a lot of the trends that I would have talked about in Mumbai in March are still very, very relevant. And so I decided to mark up this presentation in red, as I've done here on the front page, and I will walk you through it quickly. First thing I would have done in Mumbai, I would have reminded the audience of foundational insights we had more than a decade ago. We knew that the base of the pyramid is very active, largely in the informal economy. There's a whole literature about that here depicted on the right-hand side, the portfolios of the poor. We knew that they use a full range of financial services beyond microcredit. And we therefore knew that there was large pent-up demand for innovation to do good and well. So these foundational insights are obviously still true. I would argue in the no-touch economy, it is even more critical than ever to bring people into the digital future. The second backdrop I would have provided in Mumbai 4 months ago is on the evolution and the rapid response and the evolution that we had as an industry over the last decade. It obviously started with a feature phone, largely payments, USSD channel driven, the big success of M-Pesa in East Africa. Then middle of the decade, we saw the rise of the smartphone. In the US in particular, the rise of single purpose apps, unbundling traditional financial services. In parallel, in China, we started to see the rise of closed loop ecosystems. And then towards the end of the decade, we saw increasingly a rebundling of these services around new value propositions, for example, challenger banks in the US. And a lot of this innovation was riding on the top of open architecture stacks, most notably maybe in India. I wish we had done even more. By some estimates, 30% of working age adults remain excluded from formal financial services. And as we accelerate into the no-touch economy, they risk being left behind, even more so than before. So what are the trends at the outset of the new decade that I would have highlighted 4 months ago? The first one is embedded finance. And what do I mean by that? Platforms, tech platforms such as Uber, Lyft, Ola, ride sharing, they actually are very close to the core three functions, and there are really only core three functions of finance. What does finance do? Finance transfers value across space. And obviously, ride-sharing platforms do that already with payments, with expenses. Finance also transfers value across time. And platforms, again, ride-sharing platforms help with that. In partnership with others, they provide working capital and car finance. And then the third function of finance is the transfer of value across probabilistic states. And they do that as well in partnership with others by providing liability coverage or damage and theft insurance. So while ride sharing might not be the best example in the current crisis because they have been hard hit, the concept of embedded finance is very much alive. Platforms have become even more important to us overnight. Second trend I would have highlighted is big platforms as distributors. I already mentioned the China ecosystems. In the US, Amazon, Google, Facebook, they all looked at this and started expanding into certain financial services. That's the areas here in blue. They want the financial services revenue more so now than ever. And that's because their core business is under pressure. So in Amazon's case, sales are up, but so are costs. Google and Facebook, they have more users in the pandemic, but pressures on the advertising revenue. So they will accelerate their efforts. Libra, of course, was Facebook's currency and payment effort. They just relaunched that with a new team and new backing. The third trend I would have highlighted is the rise of Fintech-as-a-Service. This is a picture of Plaid, which connects people, different devices or different apps with your banking account. Most of you will have used Plaid without knowing it by linking your account to something at the front end that you really like. Plaid had grown dramatically between 2015 and 19. And of course, it was already acquired by Visa in January. And a couple of weeks ago, MasterCard followed suit by buying Finicity, which is another one of these account aggregators. So what's technically possible is a new industry structure, a different industry structure, where the front end is owned more naturally by people who matter in our lives. There will always be regulated balance sheets because when you take people's money in the form of deposits or in the form of insurance premiums, the regulator wants to make sure you can pay back when people want their deposit back or when they have an insurance claim. So that will not go away, but it could be configured differently. Under COVID, this outlook remains very much true. There is a chance of even fewer and even bigger platforms that are dominating. The regulators remain very worried about solvency, and we need B2B fintech to connect these worlds. What holds policymakers back, or what has held us back towards what's technically possible, is the policymaker dilemma. Policymakers, on one hand, love tech-led innovation to drive inclusion or growth, sector development, but they have new concerns as well around stability, the integrity of the system. And with big platforms, they worry about competition policy. And there was already, before COVID, the wildcard of central bank issued digital currency. Obviously, with the crisis now, the policymaker concern is with the real economy. But what the crisis has also shown is the power of modern digital ecosystems and a modern digital payment infrastructure. India was able to send social transfer payments to tens of millions of families in the informal economy with a push of the button. And in Switzerland, they could process a small business loan application in 30 minutes because all the information was accessible. So expect this to accelerate as well. China already launched its digital renminbi, and other central banks are accelerating their efforts as well. Against this uncertain outlook, and this was the outlook already pre-COVID, I was arguing, or I would have argued, that we need principles for fair finance. Not anything that goes is also a good thing to happen. Financial services need to empower people. Businesses need to be built on trust and trustworthiness. People in today's age want and should have meaningful control over how their data is collected and used. We need an architecture, a financial infrastructure that is open, low cost, and actually drives competition. And eventually, or finally, we also need digitally native regulation that protects consumers and promotes innovation and gets that balance right. So under the crisis, the uncertainty is even bigger. And we even more so need to help people achieve their life goals under what are now difficult and frankly dangerous circumstances. So the notion of trust and trustworthiness is even more important than before. People will not forget how you showed up in the moment of crisis and whether you actually help them manage this uncertainty as opposed to taking advantage of it. Who are the possible winners in this world? Some will be B2C fintechs, and probably more so in the advanced economies. One example would be challenger banks, who seem to be right place at the right time. Who wants to touch an ATM in a pandemic? Chime already reports 8 million accounts in the US. Guala in Argentina, they doubled their monthly signups since the lockdown. Varo in the US is getting a banking license. Aspiration raised fresh money. Not all of these will succeed, but there will be winners among these B2C fintechs. Incumbents will win as well, or some incumbents, and probably more so in highly banked markets. On the left-hand side, you see a screenshot of the top UK mobile banking apps. PayPal was one of them. PayPal globally had its best month ever in April. They doubled their new accounts. Marcus by Goldman in the US has all the advantages of being a Fed-regulated bank, access to deposit insurance, access to liquidity windows, without the disadvantages of a legacy branch or even IT infrastructure. They've grown very rapidly, often in partnership with others. They just launched their mobile app. Expect more to happen. Super apps will win, some super apps, and probably more so where they innovate into white space. This is a picture of the WeChat ecosystem. I already mentioned that the US giants are looking with envy. Facebook started to make moves. They bought a stake in Jio, which is India's low-cost mobile phone provider and data provider. They are aiming at the WhatsApp user base. They launched WhatsApp Pay in Brazil before the regulator stepped in. Expect more back and forth and more action in this space. Other platforms will be winners, platforms that have become relevant or even more relevant in our daily lives. So social media, e-commerce, logistics was always there. But under COVID-19, you can also see gaming becoming important. Razer in Singapore is one of the applicants for a digital banking license. Social commerce is taking off. Shopify is Canada's most valuable company now, and they provide a lot of the financial services that are being embedded into the social commerce space. SME services, Square, stock is up, probably even more so since I updated these slides. In the gig economy, platforms like Steady are super important to gig economy workers as they are trying to find new sources of revenue, for example, in food delivery. API-based financial infrastructure providers will be winners. And they take several forms, and this is by no means a comprehensive or exhaustive slide. Point of service plugin solutions are important here, a couple of insurance and credit providers, data connectors, the card issuers and processors, even though the physical form factor of the card might go away, but the rails matter. Some folks are providing banking as a service, including the regulated balance sheet piece I mentioned earlier. Folks need help with compliance, so there are specialist players emerging. Again, this is not comprehensive, but let me highlight a few things. Zest, they provide credit, consumer credit at the point of sale, and the online merchants subsidize or de-risk that credit. It's probably one of the few ways to do consumer credit in a crisis. Plaid, already acquired by Visa. Galileo, already acquired by SoFi in the US, as SoFi is trying to figure out what the opportunities are in the brave new world. Hummingbird, that's an artificial intelligence powered compliance engine. They've seen their demand go up over cybersecurity concerns. Ultimately, of course, consumers and small businesses need to win. If they are not better off, what is the point? They need mobile-centric, easy-to-use, 24/7 services and products. And those services and products need to be better aligned with their goals. They need to help them improve their lives. They need to therefore be relevant and tailored, and they need to be low cost. In the end, with COVID and the crisis, as we move into a no-touch economy, it is consumers and small businesses that need more help and support. And that is what fintech with purpose can provide. Thank you so much. Okay, thank you. I hope you enjoyed that. A couple of questions have rolled in. Thank you very much for those who have written. Let me read this out here. The first one is, regarding embedded finance, do you believe that Uber and Lyft will be able to maintain their strategies, plans, as the COVID-19 challenges continue? So, here's probably the way to think about platforms, right? So the first question is the platform important in people's lives under the current circumstances? Is it useful? Does it help them better navigate the crisis? So the underlying strength of the platform counts. Then comes the question of, in that context, right, what financial services do make sense? What data do they collect that allows them to do something that a traditional player cannot do? And then can there be a value proposition, right, against that? That makes everybody better off, the platform, the consumer, and maybe the third party, fintech, that helps powering all of this. And against this framing, obviously the ride-sharing platforms right now are challenged. And I said that in the presentation, right? That was one of the big departures from what I would have said in March. And as a matter of fact, Uber in the US, Uber Money has already publicly scaled back its embedded financial services plans for now. The other platforms, or many of the other platforms, are roaring. There's literally news every day these days. So last week it was Facebook putting together Facebook Financial as a team. Google announced also last week 6 new banking partnerships that would power their Google Wallet that they want to create. Apple, this is relatively unnoticed, I think. Apple bought a software company, a startup, that actually allows to turn the iPhone into a point of sale device. So you don't have to swipe anymore, etc. You just tap via near field communication. That's very powerful. So the big tech, those platforms are marching ahead. The ones we are most interested in, because the big tech platforms obviously don't need our startup money. We are interested in platforms that are helpful to people that are struggling economically in the US and emerging markets, gig economy workers, smallholder farmers, micro enterprises. Maybe I can talk about that later in a bit. We go to the second question. With the possible US and UK restrictions on TikTok, and Huawei, do you believe that China will struggle extending financial platforms like WeChat outside of their home country? Sorry, the screen was moving on me here. That's why I stumbled for a second. So Chinese platforms. You know, undoubtedly, we seem to be entering a digital cold war between China and the US in particular, and that's because the stakes are very high. And in that context, it's probably helpful to know or helpful to remind oneself that the Chinese platforms, so there's Alibaba Ant Financial, and then WeChat, WePay, those are closed loop platforms. And they are so huge that it's very helpful to their users, but they're closed loop. So nobody from the outside can use them. Even the two of them between them aren't interoperable. This is true. This notion of a closed loop system is also true for some of the traditional platforms that you could think of in this context, right? So on the retail payment side, Visa, MasterCard, Swift on the wholesale banking side. And that will probably change. And from our perspective, we like the first principle of open architecture, digitally native, cloud-based infrastructure, if you will, payment infrastructure that allows everybody to participate, that lowers systems cost. And we hope that the competition is then at the application layer, right? Coming up with new, better value propositions to people, as opposed to locking in proprietary technology in a closed loop type environment. So yes, the digital Cold War might hamper the Chinese, but it would hamper others as well. And it should, because we certainly believe that an open architecture is a better approach for users, consumers, small businesses, etc. Let me look at other questions here. What about RegTech? It is more or less, is it more or less important today than pre-COVID? And will this trend accelerate? So the way to think about what's happening now, and I tried to lay that out in the presentation, is really this unbundling of what historically would have been vertically integrated financial services players. Maybe less so in the US, but certainly in other advanced economies and in emerging markets, this notion of the universal bank that does everything, distribution, manufacturing, balance sheet, the integrated insurance company. That can change, and that is changing, and that the natural owners of the front end are often these platforms, as I say in the presentation, but there will be regulated balance sheets at the back end. Because when you take people's money, the regulator wants to make sure you can pay back. So the fintech opportunity, as we are unbundling and rebundling, the fintech B2B infrastructure opportunity lies in the middle with all these things that people need help with and that they don't want to do themselves, right? Sort of KYC, know your customer requirement check at the onboarding, right? Google will not want to do that itself when it starts with digital wallets. The notion of fraud and compliance reporting, suspicious activity reporting, that's a big deal in payments globally. The regulators do not want the payment system to be used for illicit and illegal activities, right? Child trafficking, drug smuggling, these type of things. So suspicious activity reporting is a huge activity. Tech generalist platforms don't want to do that. They will outsource this. And so we are excited about RegTech as one element of this B2B infrastructure layer. And there are other very exciting elements. And we have made investments in this space, both on the onboarding side, a company called Alloy, and the suspicious activity reporting, company called Hummingbird. So yes, RegTech is becoming more important, and COVID and this move to the no-touch economy just has accelerated this trend. Let me see another question. Okay, so this one is building on the platform one. How is fintech serving global gig workers, poorer population segments? Are they living up to the hype and the hope? Yeah, so I come back to this notion that in the crisis, what matters is whether you help people. Do you help people navigate the crisis better? How do you show up? Are you useful for them? And in emerging markets in particular, but also in the US, gig economies are obviously harder hit. Small businesses in the informal economy are relatively harder hit than the big chains. Smallholder farmers are harder hit. So yes, we do believe that these platforms that reach and are useful to the more vulnerable segments, that they have huge potential. And frankly, often on the financial services side, they are the only way to actually reach these harder to serve segments. If you're a small business in the informal economy, and you haven't filed for taxes and you don't have an established bank relationship, it's very hard to get credit, working capital credit, for example. But if somebody has helped you digitize your business and in the context of doing so has gathered data on your underlying business, either because it's plugged into the distribution chain or the supply chain, that someone can actually underwrite working capital credit on the basis of this data, because the data does proxy the cash flows of the business. A traditional bank would never know, but the platform, the digital services provider, might well know. So we are excited about these. So I give you an example. We have invested in Bangladesh in a platform that's called ChopUp. And ChopUp started by helping micro entrepreneurs, often women who worked from home, with the distribution of what they were doing. And in a country like Bangladesh, a lot of that happens via Facebook or WhatsApp, right? They jumped into the F economy, if you will, F commerce, like Facebook commerce, as opposed to e-commerce. And ChopUp helped these small business women and men with a digital presence. And then they realized, wow, we have all this information on the business, but they also need help. They need the logistics help. So they build a logistics business to do the delivery and the collection of cash on delivery. And between the helping with the distribution, the marketing, and then the logistics, ShopUp has a very complete view of the underlying business. So ShopUp has started partnering with banks in Bangladesh to actually provide working capital credit to its customer base. That's very, very exciting. And that's a very classical example of embedded finance. We decided on 2 more investments in this space just in the last couple of weeks. I can't announce them yet. One in Africa, one in Southeast Asia. One does help also small businesses, more the corner stores, the corner grocery stores, etc., with their inventory management, with their stocking. And their bookkeeping. And the other helps smallholder farmers. It essentially takes out this layer of middlemen that today and traditionally sits between farmers, small farmers, and the end customer, be it food processors or supermarkets, groceries, stores at the corner, even street food vendors. And there's a lot of inefficiency in the traditional system, a lot of food wastage. If you can take this out, that's a win-win, both for the farmer and for the consumer. And again, by doing that, by making these connections between the distribution and the logistics, you learn a lot about the underlying farmer and their reliability, and you can extend capital so that they can increase their production. So yes, embedded finance platforms dramatically help the more vulnerable segments in emerging markets. So let me see whether there is there's a question on challenger banks, consumer or small business focused. Do you think evolving regulatory attitudes are helpful or harmful? So challenger banks, we actually have invested in a series of challenger banks across the globe. in the US, in emerging markets, even in the UK. And what we have learned is that you really need to understand the local market very, very well. And you need to understand the target segment, the hook product with which you are going, under what regulatory license you operate, and you need to understand sort of the industry economics. And it turns out that on the retail side, this is not easy. It does work in the US. Challenger banks do work in the US and in Latin America, because the interchange fee on the core debit card that people would be using is high enough to pay for the platform. It's on average 1.2% or so. That works. That's why these debit-led challenger banks in the US have been taking off so dramatically, even in the last few months post-COVID. In Europe, in the UK, debit card interchange fees are capped 0.2%. So the payments economics alone don't do the trick. You need to also have credit. And so a number of the European or UK-based challenger banks have gone down the credit route as well. And there, the small business credit route is probably interesting, and maybe we will see success there, or we will see success when people have a very good understanding of their underlying segment. It could be affinity based. So, for example, Aspiration in the US and Tandem in the UK really want to be the good bank for people who are environmentally conscious, these type of things. So, retail challenger bank, different from SME challenger bank. In Asia, in emerging markets, we haven't really seen challenger banks taking off yet. I suspect that their economics will be more looking like the European variety, and less than the American variety, because again, the payment economics are less attractive in some of these markets. And by the way, if payment economics are not attractive from a business model perspective, or less attractive, that can be good news for consumers, right? They get a better, or they get a cheaper service. But if nobody pays for the service, right, then you don't have a viable business model. So that's what you have to figure out in the challenger bank context. Let me do one last one. And I read it out for, it's a bit longer, so it gives me time to think about the answer. Accepting the growth of embedded finance and the potential increase in the brand power of trusted brands, does it make the world more difficult for fintech startups as these trends increase customer acquisition costs for new businesses? And actually the question offers some answers as well. One answer is yes, they can align with the established players, traditional technology based. But will new players be limited by the desire of the established players? Yeah, that is a pertinent question. It appears right now at some level that the big platforms or big business in general might win out because of the pandemic and the economic crisis that the pandemic has triggered, right? One of the reasons why the US stock market is up so much is because there's a bet on big business versus small business. And there's in particular a bet on the big platforms. And it's the usual suspects. On the other hand, you do see an attempt and certainly effort to make our digital lives and our digital supply chains more resilient. So Walmart has been doing well, and Target have been doing well, and Walmart is teaming up with others. Then comes Shopify, which is by now, as I mentioned, Canada's most valuable company, and they provide tools for small businesses to actually compete. So I think there's a battle out there that does favor, obviously, big brands who have a loyal customer base and therefore lower customer acquisition cost, and that might be more so on the consumer side. But there is also something going on, and I would not count out, and limit our creativity as to what could happen when different coalitions are coming together to provide essentially a better, cheaper alternative to what otherwise might be oligopolies or even monopolies. There's, of course, a huge opportunity in this entire helping, right, the digital platforms or at the front end. And so I talked about the B2B infrastructure play. I talked about this plug-in on services, right? So embedded credit, embedded insurance, those would be big themes, I suspect. And startups can very much provide that. So on the embedded credit side, right, the platform wouldn't want to underwrite itself. They will ask for help, and they don't want to do the credit risk management and the balance sheet risk management at the back end. So there's a startup opportunity to plug in there on the insurance side as well. In insurance, maybe the upside potential of embedded finance is the biggest and most underexplored. Insurance traditionally, that was an annual product. It was pushed by agents. The first year commission that these agents would get off your first year premium was very high, can be up to 40%. That's a very lousy consumer value proposition. Today you can embed finance. So the example that comes to mind, because I just had to do that, I paid my kids' college tuition. That's a big chunk of money. And I have an opportunity to buy tuition insurance. It's embedded in the payment platform of the universities. It's underwritten on the basis of the student and his track record and all that. And it's done by a few clicks of the button. And it's not cheap, but given how much tuition is at stake, I just did it, right? So, and I did it also because it was so easy. So I think it's very hard to predict the future, and I do think there is vibrancy, and ultimately, right, that's what we are working towards. We are working towards a system that is consumer-centric first, where businesses are trusted, as I said, all of which riding on an infrastructure that ideally is open architecture in nature, because that fosters competition and innovation and lowers everybody's cost. And then you need of consumer protection and regulation, including giving us as consumers and users agency of our data. So we have a pretty clear vision of what a better retail financial system would look like, and we certainly are working towards that. So I think that's a good way to end this. Thank you to all of you first for listening to the presentation. And then for the questions, I hope the answers were reasonably eloquent. If I didn't get to any of the questions, apologies, then write to us. We show the email in a second. But for today, this is it. Thank you so much again for your time. Much appreciated.